Good day, everyone. I had some questions to provide a more specific time frame of events as concerns rate hikes, rate halts, and rate reductions. Now, while it's not profitable to try to guess the timing of events, it can be profitable to see the signs unfold in real time on a day-to-day basis, and that enables one to increase or reduce their market exposure on the short or the long side. And this applies to those who may be holding part of their portfolios in longer-term positions. I mean, we have guided people to cash, but not everyone trades the same. And obviously, some have done this with Bitcoin and Ethereum, where they keep a small core position, maybe 10% of their portfolio in these coins, and they might have been holding onto these coins for years, and that's fine. There's nothing wrong with that. And the balance sits in cash, or maybe they use it for shorter term trades in stocks and crypto. And of course, we've been providing some guidance there in our real-time reports. But there's been really no stocks for the focus list, because that really implies a bull market where you have trends that are actionable and sustainable. And in a bear market, you don't get such trends. You get dead, bad bounces, and it's incredibly difficult. At least I don't know anyone who can reliably predict the extent and magnitude of a dead bad bounce. You're just happy to be either out of the market on the sidelines, like 2000 to 2002, or you're shorting the market. And yeah, I mean, right now, I'm going to replay three scenarios because I already did this, but I'm going to add some color to each one. So the first scenario is we get the dead bad bounce and the downtrend continues into 2023. So the current bounce is likely nothing more than one of that variety. I think markets are going to eventually continue their downtrends, which started at the end of 2021. And that's when we were issuing reports to members about the headwinds, and then Powell's stance move into a hawkish stance. So that said, bounces can last for many weeks and be quite sharp. And that's what happened during prior bear markets, as 1930 to 32, 2000 to 2002. And both of those examples were the result of massive market bubbles, which had to be unwound. And then I'd say that potentially by the first quarter of next year, markets will capitulate due to the Fed having hiked rates 2 or 3 more times. Fed funds futures putting the terminal rate at 500 to 525 bips. And that would probably mark a major low and a potential buy signal for Bitcoin and Ethereum. However, big however, just because December 2018 was the major low, that's when we got our first Christmas crash on December 24th. The Fed stepped in, halted the tightening of the balance sheet, and a major buy signal came just over 2 months later in March of 2019. But then is not now, and the macro environment right now is far worse than any time in this long-term debt cycle, which has been running for several decades. So I think the odds are that the downtrend continues, and that is even if the Fed starts to lower rates. And I'm going to show a chart with all that chart that you see there. I'll explain in a moment. Now, the second scenario is we get sloppy sideways markets, and that's on the basis that Goldman Sachs recently said they believe the terminal rate will be substantially higher than 500 basis points due to persistently high inflation, despite coming off peak. So they think that the Fed's going to be forced to hike at least a few more times by 25 basis point increments in 2023. And should that prediction not come to pass, the elevated Fed funds rate at 500 to 525 could remain in place for much of next year. So in consequence, QE light could become an enduring factor, which is money printing to service the onerous amount of debt. And that could result in extended sloppy sideways markets over the next year. And that actually happened to crypto in 2015 after the crypto capitulation, the big bear of 2014, and then Bitcoin went all the way down to $150 in January of 2015, and that was a big buy signal. And the rest of the year was pretty sideways for crypto, and that's because of the tug of war between innovation driving crypto versus questions about whether crypto would survive back then. Now today, the level of debt remains massive as the QE bubble slowly unwinds. So as interest rates rise, the amount of capital required to service the debt is what QE light is all about, and this is being practiced by other central banks like Bank of England. So how long the sideways choppy markets last depends on key variables, including the length and depth of the recession, as well as the Fed halting the rate hikes or lowering rates once again. And markets, both stocks and crypto, often find major lows before recessions begin, since markets are forward-looking by typically several months. And the third scenario is we get actually a new bull market before we know it. And that would be if we have a black swan that forces the Fed to print large sums, like trillions of dollars. So we're getting a black swan like 2008 or COVID's 2020. There's, of course, no guarantees if that's going to happen or when it's going to happen. But it could be spurred in part by the lack of Treasury liquidity, which has deteriorated significantly. Despite the massive Treasury market, buying even $100 million in bonds can be difficult because major countries such as Japan and China are stepping back while the Fed continues to tighten the money supply. We also have debt delinquency, which continues to spike higher as well, which would be another factor that, together with these other issues, could create a major black swan, as these factors are typically interconnected, and that can create a domino effect, resulting in some sort of black swan. Over in markets, the CME Fed Watch tool, they're looking at 250 and 125 hike for the next 3 Fed meetings. It's data dependent on inflation, according to Fed members like Bullard. He expects that the terminal rate is going to be somewhere between 5 to 7%. So he sort of agrees with Goldman Sachs, who is saying that they think it's going to be way above 5%. So CPI, PPI, and the PCE, which is coming out later this week, they're critical reports. The Fed's going to use those to guide. But I would actually argue something else here. If you look over this last century and you look at that chart that is shown, when the Fed starts to pivot to lowering rates, which is what the market's hoping for, it's too late. Unemployment soars, people spend less, earnings plummet, and the question is how deep and long the recession goes. So rate hikes break something material in the economy. There's that saying 3 steps in a stumble, as in 3 hikes, and that's it for the market. Well, these hikes are inevitable because they are trying to unwind a massive bubble and tame inflation. And there's nothing like this order of magnitude if you look at all the past recessions over the last several decades. So despite the Fed cutting rates, when they actually do that, you'll see on this chart here, the Fed does not lead the market leads the Fed. So when the market drops, the Fed starts to cut rates, and the federal funds rates traces the market really cleanly. And you can actually see this action in other decades as well. This is true in the 1930s, the 1970s. And so I think, this is the first time in history that the markets are falling down and interest rates are going up, not by 25 even. I mean, I've never seen it where the Fed's increasing rates by even 25 basis points on a falling market. This is 75, 75, 75, 50. This is orders of magnitude greater. Well, I shouldn't say that, but I should just say it's astoundingly greater these rate hikes against what the market is doing. So, this landing they talk about, I don't see it being anything but a crash landing. And everything else really is Fed speak, as far as, the hope of halting or reducing rates. I don't think the market shows us, history shows us it doesn't matter. Once they start reducing rates, that's because the markets, they're going to have to, they broke something from the rate hikes, rates are going to have to go lower. And we're going to see that uncle point probably by February of next year, when we have December meeting, then we have February meeting. Maybe February is the uncle point, and the Fed either has to announce a halt or they're going to start lowering. And of course, that's going to trigger a market rally, but I think that's going to be a great place to start laying out your shorts into logical areas of resistance that, of course, we talk about, because history shows us that halting or reducing rates is not the beginning of bull markets. It's usually the end of bull markets, or at least the beginning of a downtrend. In this case, I think it's just going to be a continuation of the existing downtrend that we're seeing. Gil, how are you seeing everything?
Yeah, I agree. I think you're looking at a crash landing, and I've been saying that for a while, and now we're seeing evidence. The Chicago PMI came in at 37.2, and they were looking for what, 47.5 or something like that, and it's at levels now that haven't been seen since the pandemic in 2020. So you're seeing things collapse, and as we were discussing before the webinar, I live in a pretty affluent area of the world, which is West LA. And at dinner at one of our favorite restaurants on Saturday night, which is one of the trendiest, C and B scene type of places. I just kind of like the food, and they have good deals on oysters. But in any case, we get there at about 5:30. We're seated at our table at 5:45. There's nobody there, and that's kind of odd because this place is going crazy at about that time, and people are there on a Saturday evening. They're either drinking, eating oysters, and getting ready to have dinner and whatnot. And so I asked the waitress, this is pretty weird. I've never seen this place so quiet. And she says, yeah, it is. It was like this last night. And so I think you're in a white collar recession. And so what I'm looking for anecdotally is when I go out there into the real world and the areas that we tend to frequent just because we live in this area, um, and just see whether that's slowing down. But you do see signs of that. So I think we're heading for a crash landing. Now, what does that mean? You saw the GDP number come out today, the Q3 estimate. That was above estimates of 2.7. I think it came in at 2.9. But the PCE deflator was 4.3. They were looking for 4.1. So I don't think you can pay much attention to the GDP number. I think the PMI tells you more. And also the ADP jobs number came in at 127,000 versus 200K expected. And then you have the jobs number on Friday, which could confirm that we're starting to see a rapid contraction. Now, there's sort of a double-edged sword here, because on the one hand, if the economy is slowing down very rapidly, and Chris went through the whole scenario, the market's thinking, oh, well, if the economy slows down, because you did see a rally initially on that PMI number, and then everything rolled over. But, the view is, oh, if we see bad data, then the Fed's going to start lowering right away, and we should, they're going to push the market up. But as Chris pointed out, the market doesn't keeps going lower once they start to turn, because they're usually too late. And people think that liquidity is all about what the Fed does. That's true to a certain extent, but it's also about what the economy is doing. If there's a lot of money in the economy, if the economy is starting to contract and everybody's pulling back. So right now you see personal savings at lows that you haven't seen since the COVID crisis, and you see credit card debt and other revolving credit debt, consumer credit debt, at all-time highs. And so you're seeing that they're being kind of, pinched at both ends. So the candle's burning at both ends here as the consumer starts to slow down very rapidly. And like Chris is saying, this is going to happen very quickly if we're right. And you won't even the Fed won't really be able to react in time to stop it. They'll be reacting to it. And then it's going to take some time for that to wash out of the system when you have a contraction like that. And liquidity starts to dry up due to economic reasons and not necessarily what the Fed is doing. So it's not always all about the Fed, okay? And that's something you need to recognize. So what do you do? Well, I think, what we're watching, if and when the Fed finally does turn, probably commodity related areas, alternative currency related areas. We'll see if any part of the crypto space comes back to life, but for now it seems pretty dead as it goes through a cycle of creation and destruction. Hopefully that's useful. But we can see here from a purely technical basis, the market piled into down names. Okay, that's it. And look at the move in there. And they're just piling into these names, like there's no tomorrow. Like you got to own Boeing, which is going to lose $6 this year. Okay. But what happened on Monday is that we gapped down and you have a double top short sale setup. I use the SDOW for this, or you can just transfer it to some of the other indexes, and it's heading lower. So now you try to find support at the 10-day line. You're going lower today. We got Powell out in about 2 hours, a little over that, 2 hours and 15 minutes. And I don't know if he releases his comments ahead of time. Has he done that? He hasn't done that.
I don't think so. I think we got him at it's 1:30 p.m. Eastern time. He comes out with his comments.
In 2 hours and 15 minutes. It's 8:15 here, so that'll be at 10:30. But there is, I think you might see a tug of war here, because the initial market participant reaction will be, oh, the PMI is indicating the Fed's going to have to turn. If Powell isn't totally hawkish, then you could see a rally. Otherwise, he could trigger a nice break to the downside. And we had a pretty good break on Monday of about 500 points. And that's 497 and changed. But that's what you're looking at here. And things that I watch for example, the SMH. I thought we were looking at this last week. As it runs into the 200-day line. That's resistance. The semiconductors have had a nice pop off the lows, but now the SMH is running into resistance, and you can use the SOX S as a vehicle for that. You can see how it sold off right at the open this morning and then turned here on a MACD cross, but you're a little bit late, so you're kind of hanging out near the entry right now. We'll see how this plays out, but for now it looks like it's possible once Powell comes out that you'll start to see some real fireworks one way or the other. But this is not a market for intermediate term to longer term trend followers. Okay, as Chris was pointing out, we get people, oh, where's your focus list? Where are the stocks to buy? Why isn't the MDM switching to a buy signal? Because it ain't there. And I think anybody who doesn't see it is something of an amateur. But there are people I know out there telling everyone this is a new bull market and the semiconductors look good and that looks good. And I don't really see it. Yeah, you get bounces. Sometimes the bounces are pretty sharp. But I already know from having done a lot of work on the short side that during bear market rallies, stocks can have significant moves. And if you look at, say, just the SOX here, you can see that we've had, on the weekly chart, we've had several bear market rallies. This one here in the summertime that ended before the semis rolled over before the market did, and then they bottomed before the market did, and they've run up again recently. And now when you look at it here, to say that, look, what am I saying? I got this all wrong. Back up. I'm looking at, I thought something was weird here. All right, here we go. Yeah, there we go. There's a rally in the SMH. You guys are probably confused too, but you can see how in August it bottoms right at about the time the market did, maybe a little ahead. So now you've rallied back up in here into the 40-week line. What strength? To me, I think you have to be on drugs to think that this is showing some kind of resurgent strength here in the market. Anyways, somebody's mentioning, well, we have some questions here. Let's look at some. Anyways, but that's the type of stuff to look for. You might catch something, but even the short side is very difficult because I found even when I catch something, it'll break for 2 or 3 days and then try to turn. If you look at the NASDAQ, and we pointed this out over the weekend, I think you're just in a bear flag, and there's really nothing else to this. Okay, so I don't really understand how anybody can consider that semis, which are techs, are showing great strength and they're harbingers of a nascent bull market. It seems kind of absurd to me, but yet I see commentary like that out there. Anyways, so let's see. What do we want to do here? Let's look at some stuff that's going on. I was looking at, I don't know if you guys noticed before the webinar, but I was going through my screens looking at up and down on volume, and there's a fair number of things down on volume. There's also some things that are still up on volume, but I don't really know what that means. To me, it's neither here nor there, because if we start to look at this in terms of various groups, so let me just get rid of this. Like the semiconductors, for example, you can see some of these look very double toppy, and they're just starting. Like you look at AMAT, that looks to me like it's a short at the 200. Advanced Micro, not really going anywhere, and you can see within the grander context or the greater scheme of things, whatever. These haven't gone anywhere. They're just reflex rallies, and they go for a little while, and you can trade them, yes, but not like it's that easy. But you can see Avago or Broadcom, rather, a short at the 200-day line. And you can see Intel was a short up at the 10-day a few days ago. KLA Tencor may turn out to be a double top. Not one, I don't believe it got above the peak. Yeah, but what happens is it fails at the 10-day line, so keep an eye on that. But again, if you see all the semiconductors start to roll over, all you have to do is flip long the SOX S, and you're off and running. So, Micron, I think last week, what did I tell you guys last week? I said I think Micron's going a lot lower because they basically sell a commodity, DRAM chips, and I don't see how margins expand for them over time. They're selling at 7-8 times trailing 12. I don't see why I can't eventually sell at 2x, frankly. Let's see, what else? NXP, you can see that triggered a short sale entry on Monday at the 200-day line, rolling over with the market. Qualcomm at the 10-day line. And if you use a 65-day exponential like I do, that's the black one, it also triggered at that moving average. Now we're sitting on top of the 50-day line. And if it busts that, well, you got another short sale entry trigger there. Seagate was already a short sale trigger at the 20-day line on Monday. Skyworks, more or less at the 10-day line and the 65-day on Monday. Taiwan Semiconductor pushing into the 10-day line, possibly a short there. Texas Instruments was an aggressive short at the 10-day line on Monday. Okay, so you can go through the individual stocks, and I frankly, anybody who's sitting there trying to tell people that the semiconductors are showing impressive strength isn't really paying attention, or they're operating on some basis of a rote formula anyways. And then so I thought I'd address that, and you can see that a lot of these may be setting up as shorts up here. So, keep an eye on that. And we know that the SMH already has been. And again, if you see groups of semis, so I watch this group of 19 names. If you see these rolling over, that might be a clue to go along the SOX S. If you're seeing a synchronous long entry signal on the 620 chart. So like I showed you a little earlier, just to backtrack here, you had that near the open, so in the MACD cross, and you're just kind of hanging around that buy signal. You ran up, you ran back, now you're hanging in here, but that's what you'd be looking for. And so far that's what you have this morning, but we'll see how this plays out. Dow's only down 150. They're trying to hold the NASDAQ up. I think there is, like I said, there is this tug of war that you could see where you have some people thinking that some market participants thinking that, oh yeah, well, the Fed's about to turn and that's going to be a great thing and a brand new bull market and blah, blah, blah. But so it could result in a little tug of war, and then maybe we'll figure out where we're going. Maybe that doesn't happen until we see the jobs number on Friday. So we'll see how that plays out. Anyways, where was I? Let's look at the telecoms have been an interesting group lately because you had Arista Networks trying to run. But notice how this is in a bit of a potential double top position. So it could potentially become a late stage failed base or breakout, whatever you want to call it. And you are flopping out at the 10-day line this morning. Okay, if you bust the 20-day line, that would be a more reliable, I think, short sell entry trigger. Sienna is I was thinking this might hang in here and try to move higher if the market moved higher, but so far you do have this pocket pivot yesterday at the 50-day line, and that is a 10-day pocket pivot, but it's running into resistance. If you look at this closely, you can see it's running into resistance at the 10 and the 20 today and reversing, and that may just turn out to be a short sale entry right there. There's some other names, the smaller names. Extreme Networks has been one. Harmonic is another one in the group that has been doing well, at least in my group. F5, though, kind of breaking down, short at the 10-day line. Fabrinet, just kind of hanging up there. That's been acting better. There's Harmonic, but this could actually become a short up here. Juniper Networks has been acting well, and that looks really impressive, right? I mean, you push the 200-day line, it does. But really, you're a long ways from the highs. You've retraced about half of that, and you're running up into this area and this gap in here that you had way back in April. So we'll see how much further this can go. But, to think that you're going to buy this here and make big money seems like a stretch to me. But for now, this is an uptrend, and I don't really see anything that tells me I need to short it. Right this morning, it hit the 10-day line and bounced. So anyways, let's go to solars because I got some people asking questions about them. But you can see Array here, a little bit of a double top type thing in here, backing down to the 20-day line, holding support. Canadian Solar just hanging along there. Here comes Dayco back above the 200-day line. Enphase Energy, this one's had resistance up here in this 320 area. It's like 319, I think, is the peak on the left side here, right? Let's see, high 324.84. I take that back. So you actually double topped in here on Monday, actually, and now you're spinning out at the 10-day line. You can see that. Okay, if it busts the 20-day line, then you have a short sale entry trigger at that point. And then, I don't know where these things go. If I get a short sale entry trigger, usually what I'm doing is trading it down to the next moving average, or the next low if it undercuts that low and then rallies back above it. And they're usually a a scalp, a swing trade. And so, but I'll take it. If I can get it, I'll take it. Anyways, First Solar is, to me, this is just broken out. It's holding up, but it's stalling at the 10-day line. I certainly would be a buyer of this. I think you got to watch some of these Solar Edge dropping below the 10. SunPower hanging along the 10. It could bust there. Same thing with Sunrun. I'd watch those because I think, and you can see that they reversed off of highs earlier this morning. So I definitely keep an eye on all this. Let's look at industrial metals. That's another area I get some questions about. Albemarle. Okay, well, this is a lithium name. IBD was calling it the new market leader back in early, I guess, November. It has since failed, which shows you this is why I don't want to buy breakouts or stocks that are like First Solar. I'd rather be trying to buy them, on pullbacks. But unfortunately for Albemarle, it's just been a short all the way down. So it was a short on the gap down through the 10, short at the 20-day line last week, and now you're trying to bump into the 50-day line where it seems to be shortable still. And if you look at the other names in the group, you're going to find that it's pretty much the same story. Alcoa in a nice little flag, support at the 20-day line on Monday. That looks a little better, but I'm certainly not going to buy it up here. ArcelorMittal, you'll see here's Camco resistance at the 20-day line. Looks like a short. Century Aluminum, like Alcoa, trying to form a flag. Cleveland Cliffs rolling back below the 10. Could be a short. Commercial metals hanging in there okay. I guess in this case, if you're watching something like this, you'd want to see it bust the 10 and the 20. So best not to play with something that looks like that. Compass Minerals reported earnings, and nice. It looks like it's on track to post a pocket pivot, but the downside here is it's now extended, and you're in double top land as you approach the 200-day line. So I'm not really that interested in messing around with this myself at this point. Energy fuels, somebody's getting all excited here about an undercut and rally. Yeah, if you shorted it here, you might cover here, and now you're back at the 50, and I'm gonna short it again. So I thought if this was gonna work, it would have. You can see the pullback into the 50-day line here, and you get this, sharp volume dry up. It doesn't come off. Instead, it triggers a short at the 50-day line on Monday. You undercut this low. Okay, that's a cover point. And then you rally back up to the 50-day line. That's a short point. So, I'm not going to be dumb enough to jump in here just because I think I see an undercut and rally. So don't start getting all you and R happy, okay? Because you may find that they're going to work out more like undercut and rally moves used to work out in the past during a bear market, which is their cover points if you're short. And then the ensuing rally, well, you could, trade it for a quick scalp on the long side if you're very nimble. Merely brings the stock back up into short sale range. And that's what you're seeing with quadruple U. I love that symbol. Freeport, just like Alcoa, and here's a cool thing about these that can make you tear your hair out. Unless you buy them just right. So I think for Freeport, you had to buy it there at the 20-day line. Because if you get excited about this and then you have to sit through this gap down as volume picks up slightly through the 200-day line, that doesn't look very appetizing. But then it just turns around and gaps up again yesterday, and it gaps up again today. So excitement. So at this point, you're certainly not going to buy it. If you want to buy something and trade it on the long side, whether for a day or 5 days, which sometimes you can get away with that, you got to buy it opportunistically and on the pullbacks. If you're trying to chase strength, as IBD teaches everybody still to do, even though they should know by now this is not a market for that, you're usually just going to get whipped back the other way. So anyways, pushing through the rest of the metals, you see Hudbay, similar type of double top thing here. Here's another lithium name, a short at the 20-day line last Friday, just heading lower. It's trying to pull an undercut and rally at this low, but notice how it's stalling. I mean, if this thing came back to the 20-day, I'd reshort it. So, but it ain't doing it now. So Livent is the same thing. You got a little moving average undercut and rally. So you get a little rally. It's trying to push back up against this low here, but it can't. It hasn't undercut this low on the left side. Okay. So it hasn't gone below this low. So you don't have a price undercut and rally at that price, but you do have a moving average undercut and rally at the 200-day line. But meanwhile, today it tries to push higher, pushes into the 10-day line and rolls back. So now you're actually back where it opened up on a reversal off the highs. So acted like a short sale entry and not like a long entry. So I don't think, I don't really think that the whole electric vehicle thing in its current state, in its current configuration, is really viable. I mean, it's somewhat bizarre, and you can chime in on this, Chris, if you want, because may know more about this than me. But if you look at current mining rates or production rates of the metals that you need for EV batteries and EVs and solar panels and all this, you'd need to have hundreds of years worth of production of these metals, which are already hard to find and scarce, in order just to get to have a full build out, and convert everything to clean energy, so-called clean energy, which wouldn't be very clean, because if you have to increase mining that much, for those of you who aren't familiar with mining, it's a very dirty and messy activity. It creates environmental damage. So, if you want to increase mining activity by 1,000% in order to create all the metals that you need and get production rates back up, or up to where they need to be, not back up, because what they need to do is be at historically absurd rates, and I don't think that'll happen. Anyways, so I think that puts pressure on these names. I think that there's going to have to be a different solution for the batteries, and it may not include lithium. So that's why these, to me, are shorts. MP Materials, a rare earth metals name, a short along the 20-day line. Nucor, steels are acting well. I'm not sure why, but they are. So I'm not going to argue with that. I certainly haven't tried to short any of them. They have been long plays on pullbacks. You can see Nucor trying to shake out at the 10-day line. Piedmont Lithium, another lithium name, has been breaking down. Notice a failed range breakout. I'm not going to call that a new high breakout, although you did get a double top here that failed. So it's a beautiful failure on the double top right there. Let's say 2.5 weeks ago, you broke down, you got a cover point in here, you rally back in at the 20-day line here, that's a short. You get another short entry at the 200-day line last Friday, and now you're trying to rally back on a little mini undercut and rally through this low of 2 weeks ago, and maybe coming back into short sale range along the 10-day and the 200-day, and you got the 65-day and the 50-day and the 20-day all in there. You can see them, a whole bunch of moving averages all coming together. Probably going to be pretty solid overhead resistance, I think. But I think this whole lithium thing is going to just evaporate. So see if I'm right. Anyways, no more questions, huh? Reliance Steel, it's sort of backing down a little bit. A lot of these, this one cleared the $200 century mark, but you're going to notice that you got a little double top in play here. And that triggered yesterday, and actually last Friday as well. Monday and yesterday, actually 3 days in a row, it triggered back through this low. And so now that's what you've got going on. It's trying to find support around the 20-day line. It looks to me like the closer it gets to this high at 211.65, the more shortable it becomes. You're at 207.68, so you're 2% away roughly. And that might be a short sale entry using this left side high as your covering guide, or you could use a higher one like the high here. So, but that's a double top, okay? And some of these, if we look at some of these, like even if we go back to, well, let me go forward here, and then we'll go back to Nucor. Just remind me, Southern Copper, you see a little double top there. And again, the metals have been beaten to a pulp, and they're just trying to come up off the lows. You get pretty good rallies, but what have I said? During bear market rallies, you can get some pretty good moves off the lows in certain groups. The more beaten down, sometimes the sharper the move to the upside. And it's difficult to play on the long side unless you close your eyes and buy it at the right time and get lucky, because all the idiots who are buying in here might have gotten shaken out. It's finally, if you're one of these people who bought here or bought this move here, you're making some money. But it's a little bit of, trying to hit the moving target, and you don't know when the move is actually going to occur. But that said, it's as I've said, which is that the bear market rallies can be pretty sizable, but in the process, they can create short sale entry opportunities. So that's what you want to be attuned to. So in this case, Southern Copper may be a double top, and some of the other metals that we've seen look that way. Steel Dynamics. Now this looks like, it's hot to trot, but you do have a recent breakout. The only problem is you're barely 2% passage. You're trading 102.25 on this chart right now. If you drop below this left side peak, which is at 137, so you've got that in the century mark. If you drop below that, then you could trigger a short sale entry at that point based on Livermore's century mark rule, or just a simple double top using 100.37 as your covering guide. Somebody says, do you buy bearish ETFs when the indices are hitting resistance levels? Did you not see what I just talked about a little while ago about the SMH and using the SOX-S? Hello, go back and review the video and you'll see it at the beginning. I hope that you just showed up because it's a little bit disconcerting. But, you know, it's like Bill O'Neill used to say, people need to see something at least 5 times before it sinks into their consciousness. And so even if I covered something once earlier in this video, it's possible that by the end of the video, some people have forgotten it. I haven't, though. Anyways, notice how you get tech resources is rallying sharply, but you know, that's like a triple top. So this could play out that way. And if we blow it up, you didn't quite get to this high. Let's see, let's check this out. 36.79. Here is 36.72. Didn't quite make it, but you have this peak that it's holding above. I don't know. We'll see how this plays out, but it does look very double toppy to me. Anyways, moving along. Tronox was a short at the 10-day line. U.S. Steel looks like a potential double top at this left side peak. You see that? That actually triggered on Monday. You got a little rally yesterday back up to that price level, and then it backed down to close near the lows. And today, a gap up, and then you roll over again. So looking grim. I think it's probably tops. And so, like I was saying, okay, that's where U.S. Steel is. Okay, well, there's a market leader for you. But if we go back and look at Steel Dynamics, we talked about that. You got to be aware of these double tops that may be setting up. If the market rolls over, these could become prime short sale targets. Okay, maybe we'll even try to put a report on them, but that could be tough. Reliance Steel is also, you know, a double top. Okay, so that's a steel that's been acting well. So even though some of these have been acting well over the last, say, couple of months, and you know, so it's impressive strength. For those who don't really understand that, it's pretty much a trademark of a bear market rally for stocks. Some stocks to rally pretty significantly, and that's what you've seen here in semis. Or semis are one group, steels also, I should say. But notice how you're trying to sit on top of these highs over here, right here, and trying to sit on top of that here. And if this starts to bust, then this could become a short. You'll notice that you're well off the highs of April. So in essence, you know, what are you? And you're kind of in a big bear range, I suppose. Call it a rising. I don't know, not really, but you get the idea. I mean, where are you really in the grand scheme of things? Yeah, you're still in no man's land. Anyways, what else? Oh, let's look at the miners to finish up. So looking at my big stock list, it's big stock because I want to see. I don't really like to buy miners that have a 300, 500 million market cap. You know, in the age of QE, that's a pretty wimpy market cap. I like to see 2 billion or more. So that's how I derive, you know, what's a big stock miner, because you can't do it based on the price because so many of them sell, you know, even the institutional quality ones like First Majestic sells at $9. Buenaventura Mines, silver miner, Mexican silver miner, sells at $8. Goldfields is now at 11.09, but it was selling down around 7 about 3 weeks ago. So you can see the miners are trying to base, and our theory is that, you know, this is one area of the market you will see move if the Fed starts to pivot. I don't know if it happens if the stock market heads lower, it just drags them with it, but it's one area we would be looking at if and when the Fed actually does pivot, and it's had some time for that easing to set in. So anyways, let's just run through these really quickly, and you'll see what I'm talking about. Basically all just trying to base. Some of the better ones basing a little higher, some of the weaker ones a little lower. BVN along the 200-day line. Eldorado Gold, my favorite gold miner because of the symbol EGO. Holding the 10-day line, but resistance at the 200. First Majestic, reversal at the 200 today was a short. I actually shorted a couple of miners right off the open. Made some money. Holding one short still. We'll see if that plays out. BCF&V, a little bit of a double top. But see, again, as with any long situation in this market, you do not want to buy them when they're extended, okay? You only want to buy the pullbacks. But that said, if you're buying the pullbacks, you're probably at best going to get an upside swing trade. Okay, so I'll say it one more time for those of you who came late. This is not a market for trend followers. If you're going to try and follow an intermediate to longer term trend and buy something, you are advised to get a clue. Basically, this is not a bull market. Mag Silver. This is the one I'm still short, by the way. So I shorted this just because. And then when it busted the 10-day line, I came after it a little bit more. Now we're at 1485. So coming down. We'll see how this plays out. But my thinking is if Powell is hawkish, then these are going to continue to come down. The other thing is I played these on the long side previously 2 or 3 weeks ago, and then they all ran up very sharply, and now I will work them short at points that I think are potential short areas. So that would be the highs of the ranges, and then buy them, cover, and then maybe buy them along deep moving average support, usually at the 20-day line. Like you see OR, Cisco royalties, that's a sharp move. Okay, this is when the CPI came out. Boom. So you got this big move, but it lasted a few days. And when you get a move like that, 20, 30% or more in just a few days, you're well advised to take it, right? And now it starts to flop around. So this may have to base for a period of time. But again, it becomes viable at the 20-day line. You catch a trade, you double top out here, it could be shorted. This isn't one I play with on the short side, but Pan American, in double top line along the 50-day line, but it's in a base. And they announced that they're going to buy out Yamana Gold. We've gone through this one before. I would go back and check the last three webinar videos and just get a sense of where these were at as we saw them come around. But they bought, they're buying with Agnico Eagle Mines, they're buying Yamana. And so they took it off of Goldfield's hands because they were going to buy it. But now that they don't have to deal with that, it's traded back sharply. And it had a wonderful 5-day move after this weird looking gap up here. But now you're hanging along the 200-day line. So it's basing. But they no longer have to buy Yamana because their offer has now been rejected in favor of Pan American Silver's and Agnico Mines joint offer. So that's why there's a little bit of weight on this one. We'll see if it comes off, if silver prices rise. You see Royal Gold looks like a short at the 200-day line, but look at the nice move off the lows following the CPI. There's gold and silver. They're just hanging out. So I like them, again, you buy them on the pullbacks, but here the silver PSLV, the Sprott Physical Silver Trust, may be a short here along the 200-day line. So anyways, that's what's going on with the miners. SSR Mining, here's one. Little double top, I'm short that one too. Wheaton, reversal at the 200-day line. So these had a nice move. They need to consolidate. In my view, the move may have just been a swing trade, and that's it. And, but hey, if I can get 20, 30, 40, 50% in a stock in just a few days, which, Goldfields has been one of my favorites for a long time. Again, go back and look at, say, the last 2 months worth of video, webinar videos, and you'll see that I've been talking about these. These are my favorite names, this one and Anglo Gold Ashanti, and these are generally my go-to names on the long side. So I'll go after some of the weaker ones if I want to short this, the group. Where's Agnico at? It's not in here, is it? No wonder I didn't see it. Ha! Well, let's, there it is. So it looks like it may be a short at the 200-day line. Anyways, so that's what I'm looking at. Anyways, we want to wrap this up. I'm going to do a couple of questions here. I'm VRTX, I'm short at 318.60 and 320. So, I don't know. What's the basis for your trade? Why are you asking me? Is it a double top? Is it you just feel like it? Is it you're gonna double it up if I put some sort of seal of approval on it? That won't work. I guarantee it. It's trying to break out. So in my view, I don't short this one yet. I mean, you could have, I suppose, if you're using the 620 and you just want to catch it in midair. That's possible. So if you're a pretty good trader, then yeah, you can do that because maybe you're anticipating that it is going to fail if the market heads lower, and I think that's a reasonable bet. And you can keep it under control with the 620 chart, right? So let me see if I can. You tell me if this is what you did. So you get the break, you get actually a long entry here, and then you get the 620 cross here, and then it comes back up, flattens out here, but you're also in a little double top. So this becomes a good area potentially to short it, especially once it breaks here on the MACD. You also get the moving average cross, which occurs about right here, and now you're rallying up to the 20-day line. So, you shouldn't have to ask me anything. What you should be able to do is figure this out based on what the 620 chart is and understand what it is you're trying to do with the trade. Okay, so if you're trying to catch it up here in midair, because the only other reference you have really is this high, okay, but it never got back above it, never really got that close. Maybe 1 or 2%, but in my book, point wise, not really that close, but you can still short it based on the 620. So hopefully if you were doing that, you can at least handle it on that basis. So let's say you did get in here on the cross near 320. Now you're just hanging out, and you just got to cross back to the upside. So is that telling you to cover your position? But notice also on the price bar, it's now starting to reverse back the other way. So you got to keep an eye on these. I don't necessarily follow the signals. If I'm already in up here, say, then this doesn't really push me out. You need to get a little higher because it's not that far above. You see that as it moved here, it just moved a little lower. 317.85, pushing lower. Dow's off 142. Anyway, so that's, I'm assuming that's how you work in this trade. If you're just doing it because, you feel like it, then I think you're doing the wrong thing. There must be a method to your madness, regardless of how mad it is. Okay. Dynatrace, I don't know. This ain't going anywhere. If it tried to bust the 20-day line, and it looks like it was, volume drive along the 20-day line, but if the market goes lower, this is going to break. So I'm not really doing anything with this. Anyways, so that's all. Go ahead, Chris.
Real brief. Basically, what could bode well for miners and precious metals, obviously, is if we get into a stagflationary environment, which potentially is worse than what we saw in the 70s. Yeah. But that said, there was a commodity boom in the early 70s across commodities in general, but that's because there was a commodity shortage. So it wasn't like, well, we have supply chain problems today, but I wouldn't conflate the two. And we also had the dollar being taken off the gold standard in 71. And so the dollar depreciated something like 30% against major currencies over the next few years. And we don't have that situation today at all. The dollar is the reserve currency, and everyone has to trade through it. Many people have to anyway, many countries. So I think that the dollar is the strength that we've seen this year, and the correction, the pause that we're seeing right now, I think it's going to resume to the upside because the market is pricing in 2 more 50 basis point rate hikes, which in the context of things is huge. And given the amount of debt and all, so let's see how precious metals evolve in this scenario, because I think we're going to have to see higher rates, therefore stronger dollar, and potentially a bout of stagflation, unless, of course, we get the black swan. But stagflation seems to be on the way, well on the way. So again, that could bode well for the precious metals and therefore the mining stocks.
All right, good deal. Anyways, everyone, thanks for showing up. Remember, we've got the jobs number on Friday. That's probably going to be a market mover. And, of course, Powell is going to speak in, let's see, an hour and what do we got? An hour and 41 minutes, I believe. Anyways, yes. So keep an eye on that because I think it's going to create some interesting action. And, again, if you're a nimble trader, then this is a market you can operate in if you understand how to do it. And I talk about it all the time. But if you're not, if your psychology is not oriented towards that, you're more of a trend follower, just sit back and enjoy the show and stay in cash. Anyways, that's it for now. We'll talk to you guys later. Take care.
So long, everyone.